Welcome back. Markets subdued. We're down 27 points on the Nifty. The sensex is off from the day's high considerably, but from yesterday's closing level, it's a cut of about 130 points. Markets are still trying to find their feet. First, there was that intraday recovery, then a sell-off, and now there has been a mini bounce that you can see on the markets. But the big picture is that in the last 3 days, we've seen the market sell off. The peak on the markets was near 18,000 on the Nifty. So from that level, we've lost close to about 550 points on the Nifty at least. And overnight, we had a big sell-off in Dow. The Dow was down 650 points, and crude prices too have inched up now to levels of $97 per barrel. So that too on the sidelines is not positive for the Indian markets. But this week, we've got the expiry for the August series, and plus the Jackson Hole Symposium will start 2 days from now, Thursday to Saturday. But let's talk about where we are headed. Manish Kumar, CIO of ICICI Pru Life, is here with us to discuss the markets and the way forward. Manish, morning, and thanks so much for joining in. How are you reading the setup? Are we in for some difficult times? Could we see a deep correction in the markets?
Good morning, and thank you for giving me this opportunity. Well, if we look at the market behavior in the last few months, actually it is taking cues from what the US Fed is doing or is likely to do. So in the last few months, when markets were in a corrective mode, it was on account of the fears of constant rate hikes by Fed. In the last 1.5 months, when we saw a rally, that was on account of the belief that now that the inflation print is coming off, we are toward the conclusive end of the US Fed rate hikes, and therefore the markets had started rallying. Last 3 days, it is more of a correction of the rally that we have seen in the last 2 months or so, and it's more like on fears of what can actually happen on some of the upcoming events, which you also mentioned. On the one is on the Jackson Hole Summit, and other is that there is a Fed meet expected in the 3rd week of September. So given the latest data points which are pointing to somewhat lower inflation prints, but yet sustaining at higher levels, so one is wondering whether they will do a 50 basis points hike or a 75 basis points hike. So in a way, it is largely deriving cues from the US Fed.
Oh, absolutely. And we're waiting by for that Jackson Hole meet also, like you pointed out. Manish, good morning and thanks for joining us. This is Pavitra. So, in this context, when there is fear of all of these rate hikes playing out, we are talking about recession fears and the demand hit. Where do you see the market trending from here, and how much of a downside risk do you think there is?
So first of all, as Indian investors, we should not be complaining about what has really been happening in our markets, because we need to understand that our markets are one of the best performing markets globally. And in a scenario or in an environment where global investors have sold off over 30 billion US dollars, yet our markets corrected by barely 10%. So in a way, we have been far more resilient than most other regional markets. Given that despite this kind of selling, we were just off by about 2 to 3%. Now, in the near term, as I mentioned earlier, we are going to take cues from what's happening globally as well as what is going to happen on the domestic front. So we have got 2 important meetings coming ahead. One is the US Fed meeting, which is expected in the 3rd week of September. This will be followed by the RBI action. And we actually expect a 50 to 75 basis points hike by US Fed. And likewise, we expect RBI to raise repo rates by 50 basis points. So it is quite likely that in the next 1 month, we'll see sideways to a downward movement in markets. But once these actions are priced in, I think one can once again start seeing a resumption of northward movements in markets.
Hi, Manish. Morning. So given the setup as you describe it, what is the portfolio positioning? Because till now we were seeing that it was large caps which were seeing, you can say extra sort of weightage in the portfolios. But given that, there has been this global correction, would you start finding value elsewhere, or is large caps the place to stay?
So when you look at our portfolios, it is again a function of the various I would say the investment charter of the various portfolios. So some of the portfolios that I am personally managing, they are focused more towards large caps. but we as a house, we also have certain multi-cap portfolios where we have a sizable exposure to mid-caps. So I think at this point in time, there are good plays both in large caps as well as in mid caps. So it's more of a bottom-up calls that have to be taken rather than taking a market cap oriented call. Also, we have seen that whenever there is global sell-off, typically in the beginning, the large caps get sold off first, and then it spreads into mid and small caps. Similarly, whenever there is a resumption in rally, the large caps typically lead, and that is followed by mid and small caps. But over longer horizons, we would like to stick to the investment charters of the various portfolios rather than taking a call market cap wise.
Could you give us some themes which look interesting to you, perhaps are a little undiscovered? So for instance, bank has turned out to be a consensus favorite amongst a lot of these, people on the buy side. So could you talk about some different themes?
So yes, you are absolutely right that banking has been our favorite as well. And let me spend a minute there before I move on to other themes. So one is that we are in a unique situation where while the deposits are getting priced higher very gradually, on the other side, because of relatively sharper increase in the repo rates, we expect faster pricing of the asset side. And therefore, the financial sector, and especially some of the high CASA banks, are likely to report fairly good earnings for the next 2 quarters or so, or maybe beyond that. As far as other sectors are concerned, we are also positive on the capital goods and the EPC space. And there we have got, of course, a handful of companies. They may not be looking very reasonable on valuations, but the underlying construct is looking quite strong for them. Other than these two sectors, we have a positive bias for the automobile sector, but within that, we are positive on the passenger vehicle and the CV space. We are not yet so much positive on the two-wheeler space. If we are talking of some of the smaller sectors, we are there investors in the airlines space. We are also there in the organized retail space. So these are some of the niche schemes, niche themes where we are invested, and they have done quite well for us.
All right, Manish, another space I want to ask you about is the FMCG sector. I mean, I can see HUL as one of your holdings, but what else do you like in the FMCG space?
So FMCG space, so we are investors in actually many of the companies in that space. So actually, if we look at it in totality, not just as we refer to as FMCG, but even the companies in the spirits space, in the alcohol beverage space is something that we like, and we are investors there as well. So it is across the board, and we are also investors in some of the companies which historically have been beaten down for reasons relating to ESG factors, and they have actually done quite well in the last 1 year.
Okay, Manish, we'll leave it to that. Thank you very much for joining in. Important updates coming in from Tata Motors, where they aim to deliver strong improvement in the EBIT and free cash flows from Q2 onwards. Remember, Tata Motors Q1 numbers were a big miss. Particularly, it was the big loss from JLR, which surprised the street. But statements coming in from Tata Motors, where they are talking about improved visibility of the chip supply, and they're also focusing a lot on their cash flows as well as turning profitable.